All right, good afternoon, everyone.
Hey, Kyle.
Hi, Nick. All right, so welcome back. Today we're going to talk about time series and how to get data from websites so we don't have to actually download it. That way we can get continuously updated data as we go through. We have new accounts for everyone today. So I just sent an email out to you, and I think I can paste it in here as well. Kevin, can we just paste it in here? I know. See if I can just drop this in here.
Yeah, the file's in there. To answer, there are some issues, but I'll deal with them offline.
Okay, so if you have issues with getting your account set up, you can just ping Kevin privately, and he can help get you all set up. All right. Otherwise, we can move forward. Okay. All right, so like before, we'll have this little interface. We're going to open up our AWS console. You probably won't have this issue, but I was in another account earlier. I'll do that again. Great. All right, so we'll open up SageMaker. And notebook instances. And once we get to here, we can open up Jupyter. So I'm happy to report that we have added answer keys. So these are their new answer keys here. So you can go and check the way that you answered things on kind of some assignments for the first couple ones. And if that matches the way I did it. Like many things with computer programming, there's lots of different ways to get to the answer. So there's not a single right way of doing it. But you can see the way that I did it, which is a good example to go from. We're going to be in notebook 7 today. The answers are on the GitHub repo as well, Fidel. So if you do a pull request, then you will get the updated stuff. All right. So what we're going to do today is get some information, financial information and non-financial information about a stock of interest. Actually, several stocks, we'll look at those, and then we'll dig specifically into one stock, the stock for oil.shell, and examine that using a common strategy for algorithmic trading. If we have time, we'll move on to notebook 8, which will allow us to do a Monte Carlo simulation to simulate future paths that a price might take and get a sense of the value of an option for the future. The notebooks were set up originally to use this website because it did not require a key to use. They changed that policy yesterday. So you do have to have a key to use it. So I've removed my keys. From here, if you want to be able to download this directly for yourself, you will need to come over to this website, financialmodelingprep.com, and you can sign up for a free account. That will give you a key like this once you sign in, and we will take that key and we'll use it in our notebook. Here we have a variable for key, right? And I said, use your key here. We'll just paste your key here, your key, and then it should all work properly. Since we didn't have, so if you don't have a key, that's fine. I've also saved the next part as a CSV file that you can access directly. Right? So you are limited on the number of things you can get per day with the new API. It did not used to be limited. Now it's limited and has a restriction for a key. So this may not work because I've already gone through and done this a couple times today. But what we're going to do is there's this big block of Python code. And this is a little bit like what we've seen before. We're going to start by bringing in pandas, but then you can see that we've actually declared a function, and most of the interesting work is going to happen here in the function. And then it's going to give us results. So slightly different design here to the way that we're doing our code. The nice thing about this is that it's going to, it's very flexible. So outside of our function, I can declare things like the tickers of interest. So these are the stock tickers. And then it will create a data frame based on that. It's going to go through using the API that we've given and pull the information for the value of the stock, current value, how much debt they have, how much cash they have, their last reported quarterly earnings, and the name of the CEO. So we'll see if I can run this. Running into an issue because it doesn't even know what IS is. Change the name of this from quarter to 1Q 20. Okay, so it looks like it's working. It's good. So it did its job. And then in that next cell, we can actually see the results. So it created this new data frame for us that has this information. It also saved it as an Excel file. So if you go back to the folder structure, you'll see we have a new Excel file that has that information so we can use it for later. Let's talk a little bit about how this works. So this website over here provides us with all sorts of information. You can see it's got information about company valuation. We can get the stock price. We can look at market indices, commodities. And what we have here in this documentation is the example of what it should look like. So they're using Apple as the example, and they're going to put the name of the stock they're interested in, and then a question mark, which just means that they're going to pass then a parameter and our API key. And if you go to that website, you clicking on it, you get this structure. And this is called a JSON object, a JavaScript object notation. and it has information in key value pairs. So we have a symbol, and that's Apple, the price and the current price, the volatility, the market capitalization, all this different information that's available here. And so what we're doing in our code is taking this format, pulling out specific parts of it, and saving those into a data frame. If we go down a little bit lower, let's come down to real-time pricing. We can see, look at this one, that is the current price of Apple. And we can see historic price. It's that same structure where we have a date and we have open, low, high, close, and the volume traded every day. But it's very difficult for us humans to read this. But the computer really loves this format. So it is easy for the computer to take this format and use it. So this website gives us a URL. See if I can just, this may or may not work for you depending on how many. So if you click on that, see if you can get the same website with all of these values. These are minute by minute values of the Apple stock. So we're using that website to give us information like the quarterly earnings, the balance statement information. And then we've created a list of each of these different items. So the share price, the list of the share prices for each of these tickers, cash, debt, quarterly revenue, and the CEO. And that is what lets us have this nice data frame. You can change this too as well. Prettier. Now, one thing that you might notice if you have this format is that the numbers are reported as true numbers, but the cash, debt, and quarterly revenue for all these, what key? Yeah, so everyone will need your own key. Come to the website, financialmodelingprep.com, and up in the corner, you'll have a way to sign up. You just put an email address in, and sign up. We'll put in your email address. Password, and then hit register. It will send a confirmation email to your email. Once you accept that, then you can come back to the website and put in your username and password. And once you have your username and password, on the free tier here, free plan, you can go to documentation and your key will show up here. Right? So that's the key you use. What's nice is all of the examples here that they give you will be your own key provided. So you can just click any of these that are in the little pill, and it will take you to that website that shows the results. And you can copy this whole thing and put it in your Jupyter notebook. Right? I will show an example of that. I'm going to go down to the real-time stock price. So this is up to the minute stock price. And then back in our Jupyter notebook, this code here is going to use Pandas to open up that same kind of website and then turn it into a data frame. So going off book a little bit, but what we're going to do is data frame equals pd read. Instead of a CSV, we're using JSON. And so it went, and now I have a data frame with that information in it. Right, up to the minute information here on the Apple stock. Oh, no, that's the, I guess I got the New York Stock Exchange general one. So that's all you need to do to be able to bring it in. And what's great is that now that we have it like this, every time you run it again, you'll be getting the new values. So if you save this and you come back tomorrow and you run it, then you'll get the values that include today or up to the minute for whatever you have. Right? That is a much better way long-term of getting your financial data than having to go and download a CSV, store it on your computer, and then upload it every time you want to do your analysis. We would say this is it's ephemeral. So the data is coming in, you're using it, it's all in memory. So once you close your notebook, the memory of the specific data goes away. You do have these cells with the outputs will remain. All right, so I'm gonna go back up to here. We were talking about this general information, this data frame that we built with these different stocks, and we have their price. The cash, debt, and revenue are all in billions, but it's shown here in scientific notation, which is hard for us to read. And so what I'm doing in this next cell is taking those columns, and I'm going to divide them each by 10 to the 9th, which is billion. I used this is now the data frame name, not up here. So by convention, we use DF for data frame. Yeah. And I did change the name of this, so that's the new name. There we go. Right. So the problem was I changed the name for quarter here. As I mentioned, with Jupyter, you can do things out of order. And so what happened was that I had done something out of order, and then it worked when I was doing my test. But now that we started at the top and I haven't done those things out of order, it didn't work. So I just needed to change these so I have the right names. And once I had the right names, it works. And you can see now I've taken the same information that was up here, but we're just presenting it now in a version that's easier to read. So the quarterly revenue for Apple was 58 billion. It's much easier than saying it was 5.8 times 10 to the 10th. Right, that's just some general information about the stocks. Let's actually go now into a real stock. So we'll do the real Dutch shell stock and apply a very basic algorithmic trading strategy called the Bollinger Band. If you have your own key, if you've gotten that, then you can put it in right here. If not, then click on the one that says cell 5, and that will use the save version that I've put in here so that not everyone had to go get a key this morning. Okay, so I've got a data frame of the stock price, daily price for Shell. It is good as of yesterday because today is still ongoing and we haven't closed. It gives me a lot of information just when we begin. I have the close, the daily high, the low, and the open for every day that it's open, as well as information on the volume of trades and the percent change from one day to the next, the total value change, and the adjusted close, which is just a normalized way of taking into account the changing number of shares outstanding. So there's a lot of information here. And let's go ahead and plot this. So if we add a new line, we can do dia close dot plot, and we'll get a nice time series plot. And apparently did not run a what I just added. So we can see over time, the stock has it's lost about half its value since this time last year. So a year ago, it was trading around $60 a share, and today it's trading around $33 a share. So one of the things that we might want to do with time series is look at a moving average. So a moving average would smooth the time series, and we can use that as a predictor. There is a strategy in algorithmic trading called Bollinger Bands, which is going to take a moving average as well as two standard deviations above and below that average to create this kind of moving group. So what we're doing here is we're going to define this new function that creates Bollinger Bands. And it's going to take our variable and do a rolling average on it, and then save it as a rolling average. Then to get my lower bounds and upper bounds, that's going to be the same thing with the rolling standard deviation. So 2 times the standard deviation above and below the mean. And finally, this is just the code telling it how to plot and that I want the title to be this and that. So those are just helper functions. Nothing's going to happen after you execute that cell. But when we come to cell, it says number 7 here, we run this, then all the code above was executed, and we get this chart. So the dark blue is exactly what we saw here. It's a time series for the stock. The red is our upper bound, and the green is our lower bound. The orange is showing the moving average. And that's actually here in the legend, you can see that. So the way that the Bollinger Band strategy works is it says if the stock exceeds an upper bound, then you should sell it short because we expect it to revert to the mean. Likewise, if it dips below the lower bound, which would be the standard deviation, 2 times the standard deviation of the moving average of 20 days, then you should buy the stock because we expect it to go up. Very basic strategy. If the stock is too high, we should sell it short. If it is too low, we should buy it. And by doing that, we should have a strategy that we can automate. So we can tell a computer to do this. We don't have to watch it every day, and it will just make these trades. On most days, it will not make a trade. Right? So days like these, you see here, the value has not exceeded the thresholds, so no trade is made. It only makes a trade on days when it's going to exceed or drop below the threshold. All right, so that's the strategy, finance strategy for Bollinger Bands. What this code's going to do is take that strategy and convert it into code. That if the value is higher than upper bound, and that wasn't true yesterday, then take an action. And if we run this, and we're going to use a cumulative sum, it's going to show how much money are we making over time. You'll notice that this strategy performs terribly on this stock. It This is not a very successful strategy. So if you started with $1 last year, you would have about 60, or you'd have like 40 cents left. So for this stock, not a good strategy. But that is the most basic form of algorithmic trading. Okay. So all the things that happen here, I know it looks a little overwhelming, but they're all things that you already know how to do. We're taking this column from a data frame, we're taking the row, we're doing a comparison. All of those things are things you've already seen. We have our conditions that you've seen. All of that is already there. The difference is yesterday, we didn't really use functions, we didn't use our own functions. We used functions that were built into Pandas, but we ran most of our things directly ourselves. Today, we're using functions because it allows us to have this and use it over and over again. So we did this for Royal Dutch Shell, but we can just as easily change it to another stock, like Amazon. A limited number of credits, so I don't know if I'll be able to actually get the values here. Okay, that worked. Great. So that's the Amazon stock. So now I'm going to run through and I can get the same information for the Amazon stock. And again, our Bollinger Band strategy, not very strong here. It said this is not an investment class, so take it for what it's worth. That's the basis of a Bollinger Band strategy. So what happened there? All I did was change my ticker from the Royal Dutch Shell ticker to the Amazon ticker. And then all the code stays the same. And I can run through and I can get this analysis for this other stock. We can try one last one. T is Tesla. That's the Tesla stock. This is probably when Elon Musk said it was overrated. That looks exactly like what we just saw. So there may be something wrong with this code. I'll have to take a look. But you can see this moving average here all done for us. You can use features in Excel for moving average and exponential smoothing, but this is a much more explicit way of the transformations that you're doing. And it's easily replicable. So since it's all here in code, you see I can just run it for 3 stocks, and just as it takes a matter of seconds to do that. One last thing on this is why 20 days? In stock trading, the stock market is open for 252 days a year, and it's closed on weekends. And so a month period is 20 days. So what this is doing is taking a trailing period of 20 days. So taking the last month and then using that to make the band. Right? Pretty straightforward strategy for doing any kind of moving average. We believe that the values, most recent values are more valuable for our predictions than older values. Awesome. All right. So that is a time series. Bollinger Band strategy. I do not. Well, there's so many players in the market that it would be difficult to know if they're following the Bollinger Band strategy. But there are a lot of websites that will allow you to build your own algorithmic trading algorithms and run those. And there's a really cool one that's based in Dallas. And you give them the algorithm and they get most of the money if it works, but you do get money, you get paid basically if your algorithm works, and you have no risk associated with it. Before you do that, I recommend reading the book called Flash Boys, which is written by the same guy who did The Big Short. about algorithmic trading in general and how it works, and basically why there are people who are going to be much better at this than we are, because they have access to faster data, access to the data more quickly than we do. That's called flash plays. All right, let's jump into the last one that we're going to cover. This is awesome. Number 8. All right. So we're going to do some of the same things that we did in the last notebook. We're going to go to that same website, but this time, instead of getting a stock price, we're going to get the price of crude oil. I originally made this before the price of crude oil became negative. I think the theory here has to change now because we've seen the price of oil trade for negative $40 a barrel. But the basic concept is oil is a commodity that is traded, and it has to be delivered physically at some point in the future. So people buy the price. You can kind of lock in your price with an option in the future called your strike price. And then the question is that value going to be higher or lower than the price today? So to do that, we're going to take the stock or take the commodity and look at the volatility that's happened in that commodity over time. And we believe that the log of the returns, so the log of the change in the commodity, is normally distributed. That may not be true, but that's an assumption that we're going to make. And then we're going to use that assumption to add some volatility into our own model so that we can project the future. So let's kind of step through this. Again, you'll need to have your own key to put in here, or you can drop down the one that says number 2, and that's a data set I saved this morning. The same thing. So just like we saw for the stock, we have the price of the commodity, we have where it closed, it's high, it's low, and it's open. This is not West Texas Intermediate or Brent, the ones that are most commonly talked about. This is Aberdeen, which is used by Bloomberg as an index for West Texas Intermediate. All right, so we have this commodity. Let's take a look at it. It's very volatile, lots of change over time, which is good for the way that we're going to think about doing our next step. Okay, so we're going to use Brownian motion, which just means a random change in order to create our future cases. The basic concept is we have a stock price, and then that is changed every day based on the change in time and the volatility that we have. So we can use a random number generator that's going to produce random numbers based on normal distribution. It's going to multiply that by our standard deviation of the returns, actually the log of this log of the returns, standard deviation of the log of the returns. And those basically become 2 parts. So the price tomorrow is the price today plus a drift and an exogenous shock. That's how we can kind of think about this. So we've got the change in the stock price is the current stock price times a drift plus an exogenous shock. All right. So now in cell 5, this is where all of the interesting things are happening. You can see a lot of the common words that you have in your finance classes. We're going to be taking log odds. We're going to use standard, we're going to take the mean, standard deviations. And here is where we're going to add in a probability function that's going to take a random number and then we'll use that to make the price change. So if we run cell 5, at the very top here, I have iterations. So that is how many different simulated futures do I want to do. This can be any positive number, but the higher the number gets, the longer it's going to take to run. All right. And so we get this crazy looking graph. Each color represents an independent run of a future. So each one is a potential future. Everything starts at the same place because we know the price today. What we don't know is the price tomorrow. And actually, we're going to forecast up until June. The last day in this data set is actually in February. So there's a little bit of a gap. So it's projecting about 120 days into the future. So a lot of change. Difficult to see here what's going on. When we're looking at options, we really don't care how much variability is happening in the middle. What we care about is when that contract is due, what do we expect the price to be? And to do that, we can take this simulation and actually make a histogram of our final values. So if you think about this, you can basically take this chart and turn it sideways to get a little bit of a sense of the distribution. But we're going to take the final values here and do a histogram. All right. And again, we have our common things from statistics. We're going to use a standard deviation, a mean, and we have a histogram. The blue line is our mean. The yellow is basically the normal distribution overlaid on this data set. And the green lines here are 2 standard deviations away from the mean. Right. So this is our 95% confidence interval, everything between the 2 green lines. So the probability that there is a price as high as 35, it is possible, but it's going to be less than 2.5% because we have a 2-tailed test here. So with this, you can take whatever the projected price is going to be, whatever the future is offered at. And if they say, well, I'll sell you the option for this future, and it's going to be $23, we think that there's a good chance that the price will be $23 anyway. If they say we'll sell it to you for $12, then there's a really good chance the price will be higher than $12, in which case you should buy the option because your value is going to be above that level. So a lot happening here. But what's really great is that it's very easy to change this from oil to another commodity. And all this code stays the same. It will tell us the average of our data set and our standard deviation all here for us. All right, and just a couple more things I wanted to mention through today. And I know we're going fast through this, but if you change the seed, do you have to rerun it? No, you don't. Well, it will if you just change the number at the top, talking about this. So setting your random seed means that all of your future runs, so all of us should basically get the same results because it's a random number, but it's not exactly random. And so the seed controls that. So it helps with replicability. I used 3363 because that's the class that I was lucky enough to get to teach this year. So it's now my default password for everything. I guess I shouldn't say that here. We're being recorded. All right. So other people will pick random seeds that are like just random numbers, or they'll have a favorite number 42 is probably the most common random seed you'll see because of the book by Douglas Adams, The Hitchhiker's Guide to the Galaxy. But 42 is the answer to life, the universe, and everything. Another common one is just really the random seed one. Doesn't really matter. All right, so we were able to generate this nice histogram, but you'll notice this plot is very difficult to read and to work with. Wouldn't it be better if we could interact with it in some way? Well, we can. There is a library called Plotly that we can use to plot out, to make those same kind of graphs, but to make them interactive, right? So in order to really use Plotly, the first thing I'm going to do is melt my data. So when we did the original run of the simulated futures, what we did was create a new column for every simulated future. So that means that the original data frame for forecast is actually 1,000 columns long. Each one is 1,000 columns, and then every row is a different day, right? So that's what generated this, is a spreadsheet you could think of that is 1,000 columns and is like 120 rows long. What I'm going to do here, do a couple of things. You'll notice on this graph that these are just numbers. This is elapsed days, so days in the future. I'd like to change them to actual dates because I can read that more easily. So this is what's going to change my numbers into dates. And then I'm going to set a new reindex my forecast based on dates. So I've changed the numbers going in the future to specific days. I'm also going to take the actual, so the one here, DF, that is the actual information we have. And then I have the forecast, which is my simulations. I'm going to put them together, join them into a single new data frame called result. That way I've got just one data frame that has both of my parts in it. And the final thing is I'm going to say, instead of being 1,000 columns, say 1,001 columns now wide, I just want to have a couple of columns. So take all of this and collapse it so it looks more like this. I'll show what that looks like. So if we look at this is the forecast shape. So that's what we talked about. It's 115 rows and 1,001 columns. And now if we look at the shape of R, which is just a random name that I'm using here. It is only 4 columns, and it is 880 or 847,000 rows. We can do this a different way if we just look at the head of each of these. You can see all the different future paths. If we look at this, we have just 4 columns. The source here is telling us whether or not it is an actual value or a forecasted value. I just like to do that so it's easy for me to keep track of the two. Then we have dates. Variable should be actually 0 for everything. And the value is the predicted value at that time. Oh, no, variable is going to be these. So each of the runs. Now when I come to this one, that's number 8, I have this data frame called R. And I'm just gonna have to give it a couple of things. I'm gonna say my x-axis, I want to be date. My y-axis should be value. And then I want you to color these things based on source. The reason I did it like this is that I don't actually care about each of these individual runs. I can't see them anyway in this big spaghetti graph. So I'm just going to make them all the same color. They're all going to show up as blue. but because it's Plotly, we'll be able to hover over it and get information that we can actually click and drag in to get more specific information. It's a really nice, easy to use tool. Another difference you'll see is, look at how much code this was. It was 3 lines, and compare that to what it took for us to do something to make the same graph in not Plotlib, to with the code for that. Oh, it's actually not that long. Matplotlib is much more verbose. You need to put a lot more information in. Plotly makes it a lot simpler. So I can hover over and get the value day by day. I can click and drag and zoom in to just this section. Not that that's particularly helpful here, but I can see each of these points. Finally, I can turn off my forecast, or I can turn it back on. So all of that interactivity comes out of the box with using Plotly in a really simple, easy to read way. You have an X, you have a Y. You can tell things by color, give a title, and then make this nice interactive graph. This is called a declarative structure. So rather than telling it, in Matplotlib, we have to tell each step, take this and do that with it. And with Plotly, we can say, I want a graph that has date on the bottom, the value on my y-axis, and then I want things to be colored this way. I just kind of declare, these are the things I want, and then Plotly takes that and turns it into this nice, beautiful chart. If you know how to use HTML or JavaScript, you can actually save this as a JavaScript file and put it directly into a website, and it will maintain that interactivity. So it's super cool. You can save it as an image, or you can, if you use, Plotly has a service where you can actually publish this on their website too for free. You don't need to do that. All right. So there are other things that you can do with time series. There are lots of algorithms that you can use to do predictions with time series. One of my favorites is called Profit from Facebook. It's FB. This is a Bayesian approach to time series. And it's available in R or Python. There's a nice, easy to read example about how to use it. But this gives you not just a single point in the future, but the range, as you'd expect from a Bayesian approach. The range of potential or expected futures. And it's able to predict things, even though this is a very choppy, there's a lot of volatility or seasonality in here. The algorithm is able to pick those things up. It's all really cool. But we don't have time to go through all the different time series algorithms today. So what do we do? You were able to go and get data from the internet for things that really matter that exist in the world, stock prices or commodity prices, bring those in, apply algorithms to them, analyze them. In the book 8, you're able to take the volatility that exists in that stock, which is unique to that stock, and use that amount of volatility to then predict the future or project potential futures. And then we did plotting both of time series and a nice histogram, and finally an interactive histogram, or interactive time series. Right? Yeah. So no, I know it's a lot to get through, but these notebooks are all available to you. You can come back and work through them again. I think it's really, really amazing and a very different approach to the way that we can do this analysis. There's a great quote from Kenneth Arrow, like, how'd you get your Nobel Prize? And he said, I had the data. And that's all it took. it actually takes more than that, but having the data is a essential component to doing anything with finance or economics. And using something like an API is a really great way to do that. And so it's always fresh and ready to go. And the other thing that I love about this is we've set it up in such a way that we can easily change from one stock to another and do the same kind of analysis. What we could also do is have two stocks, and then we could do things like a correlation between them and look for things like autocorrelation over time, and maybe we use one stock to help predict the other. That's a common thing that we could use the price of crude oil to predict the price of gold, for example. All right, so that is, yeah. So I was going to bring in the Bureau of Labor Statistics API today, but almost all of them require you to have a key to access the API so they can keep track of you. I picked the one we used today because it did not require a key until yesterday when they changed it, and now it does require a key. And there's a paywall for some of the other ones that are really common. There are some that are open that are really fun to use for APIs. For example, there's the Twitter API, where you can get everybody's tweets, and you can use that. We can take that sentiment analysis that we did yesterday, and you can actually run it on tweets in real time, which is something that people in public and government affairs offices do all the time to monitor the sentiment of things on their tweets and what people are saying about them. There's other good ones that are available from the Census Bureau. So if you wanted to get information from the Census Bureau, you can do that. And then finally, a lot of states and local governments are providing their data openly through APIs. So I didn't really talk about, oh yeah, you see you use Fred. It's great, yeah. So you can get the Fred data as well. API, you need a key to do it. So the way the APIs work is that it's kind of like a waiter if you're in a restaurant, and you don't have to go in the kitchen and say, this is what I want. You tell the waiter, I would like to have a steak, please. And the waiter goes into the kitchen, tells the cook, prepare a steak, and then brings you the steak back. The API works the same way. You say, I want the data for economic indicators in the United States. You tell the API that, it goes and gets that information and then brings it back to you. And that way, you don't have to download big data sets on your computer. You can just bring it all in directly. Mr. Christian said you can set it up so that you always have the fresh real data without having to deal with any kind of CSVs. Most of them have really nice documentation about how to do things. So it'll be examples. If you just do like Python to this, then you'll find somebody who has a nice example about this is how you do it with Python. In fact, they've even made a little package for you that makes it easier. So you would install that package, put in your API key, and then you could go ahead and pull things like the S&P 500. So tomorrow, we're going to break into teams and have a competition. So it's kind of like a final exam. We've got a set of questions, about 5 questions for people to work on. You'll have some data sets, and then the team that is able to find the answers and do the best will win a prize. They will win gift cards for Amazon. So come back and do that. Kevin and I will stay on to answer any questions, but if you would like to drop off, if you don't have any questions, then we will see you tomorrow for day 5 and our wrap-up day on Introduction to Python.
I have a
Thank
quick
you, Kyle. Thank you, Kevin.
Yes, Christian.
Way back in the 7th notebook, in the very first chunk, I wasn't really following along in time, because I was still dealing with my key, there's an error that gets thrown around line 50, right where it says the quarter.
Yeah.
It defines a quarter, and there's an is function that's not defined, so you have a different.
Yeah, so I switched that on the fly here.
Oh, yeah,
What
okay.
happened is the is a list, it's income statement, it's a list, but
Mhm.
because it's within a function, it's a local value and not a global value.
Oh, I see. So just the
So I
scope
can't
of
reference
view.
it.
Yeah,
Yeah.
okay, gotcha.
When I had made that, I had actually pulled it out of that and made it a global variable, and then I took that away.
I stared at it for a while, and I saw it's defined. Why is it thrown in error? But I guess it's the indentation that tells you that the function definition is done.
Yeah.
I see. Okay. Yeah.
So
Right.
the difference between local and global variables is one of the hardest things for me to get my head wrapped around, because you can have things that have the same name. You often do, like you have a data frame defined here, and you can also have a data frame defined here, and they're two different data frames.
It makes perfect sense if it's in a function. I just didn't recognize that there's a function definition that had ended, but the way you can tell in Python is with the indentation level, right? And so I see, got it. So you just hard coded it in as something, and
yeah. So
went with it.
It was originally hard coded by the guy who made this. It was like third quarter 2019, which is wrong. And I thought, oh, I'll automate that. So yeah. I'll use it. So it just uses the just go through and instead of guessing what's the date, just use the date that's available, right? So it shows up. You've got your financials. It says revenue, but there's another column here that's going to say date.
Is there a function that lists all defined variables globally, just so you can kind of look at it?
Jupyter notebooks are pretty terrible for linting. So the things you would do in computer science, like try and identify where your variables are, you can't really do easily in Jupyter. There are some extensions you can get that will help, but they're not that great. If you want to be able to do that, I'd recommend something like Visual Studio Code or one of the other IDEs like Atom that are much more powerful in their design for software engineering, because they will tell you all the variables you have. They will also go through your code and tell you things like you defined a variable Christian, but you never assigned it a value. Where you assigned a value to Christian, but you never used that variable to do anything. So those are all features that are under the topic of linting.
I didn't have also the base and the key in my in mine. I guess I just kind of follow it like that.
So you had the old version, because So yesterday I went to run through this, and all of a sudden nothing worked, and it's because they changed the API.
Okay.
So now there's a key.
Okay.
And then the reason I pulled out base was that it was repeated each of these times, and it made some of these lines really long.
Oh, I see. Right.
And so I just pulled it out since it's the same.
Okay.
So just one thing for you, Fidel, we talked about filling in blanks. Right. There's two ways of doing it here. This is called the F version for formatting. Put an F first, and then in your curly brackets, you put the name of the variable you want, and it will fill in the blanks.
Oh, I see.
That is new as of Python 3.7. The other way of doing it, in the way that I do it, you'll see most often, is to have curly brackets and then dot format. And then we would put the variable here. Oh, I have to join another call. So that's the structure. If we have a lot of them, then we can do things like, we can say this one is A, and then here we would say A equals quarter. So what's nice is now we don't have to guess what things are. B, C, so A equals quarter, B equals, then C equals.
Okay. Nice.
So that way you can keep that track of everything.
Mm-hmm. Okay. Thank you. Yeah.
All right. So Jacqueline asked if we can get the video recordings. Yeah, I will send out today's and yesterday's video recordings as soon as this one's done rendering. All right. Thank you all very much. We'll see you tomorrow.